Shanghai just halted silver trading. And when a major exchange halts trading like this, it's not routine, it's not random. It usually signals something deeper inside the system is under pressure. This kind of trading halt doesn't happen in normal conditions, not in stable markets, not without a reason, and especially not in silver, where global positioning and demand constantly shift. And now people are reacting. Some are calling it manipulation. Others think the system is being controlled. But the real question is, what forced Shanghai to halt silver trading now? Because just days ago, we talked about the 6-year silver deficit, tight supply, rising pressure, and now suddenly Shanghai halted silver trading right after that data came out. That's not coincidence. That's timing. Because when pressure builds inside a system, it doesn't always show up in price first. Sometimes it shows up through sudden market disruptions. I know what you're thinking. Is this manipulation? Is something being controlled? Or is this the early stage of a much bigger shift already forming beneath the surface? Because when trading gets halted like this, it usually means one thing: something is out of balance. And when markets lose balance, they don't stay quiet for long. So this is not just a technical pause. It's not just routine control. Shanghai halting silver trading like this is a signal that something inside the market is shifting. And if that's true, then this halt is not the full story. It's just the beginning of something much bigger that most people still don't fully see yet. So what actually happened here? Shanghai halted silver trading on its futures exchange. And officially, this kind of halt happens when price moves too fast within a short period. In simple terms, when volatility spikes aggressively, trading is paused. Not because the system failed, but because it is designed to slow extreme movements and control risk. This mechanism exists globally. Not just in Shanghai, it's meant to prevent panic and give traders time. So on the surface, this looks like a normal technical reaction. But here's where the story changes, because the halt itself is not the real issue. The real question is what caused that level of volatility in the first place. Markets don't move aggressively without a reason, especially not enough to trigger a halt. Something pushed price fast enough to force the system to step in. And just days ago, we saw something critical: the 6-year silver deficit data. A signal that supply has been tightening while demand continues increasing across markets globally. Now here's the difference. Most people focus on price, but smart money focuses on supply and demand, and that deficit showed something important. The imbalance is still growing, supply is not catching up, demand keeps increasing, and when that imbalance becomes clear, it forces positioning. That positioning is what actually drives price movement, so price didn't move randomly. It reacted to that pressure, and as volatility increased, panic followed. That's what eventually forced Shanghai to halt silver trading at that moment. This is how stress builds inside a market, slowly at first, then suddenly visible. And when it becomes visible, the system reacts to control what is already happening. So the halt is not the cause, it's the response. A signal that something underneath the market has already shifted and is now starting to impact actual trading behavior. And when markets reach this stage, they become unstable. Not explosive immediately, but sensitive, meaning even small triggers can now create much larger price movements than expected. Which leads to the real question. If this halt is just a reaction, then what is the actual force behind it? What is really pushing this market out of balance? Because once you understand that, the entire situation changes. And more importantly, it tells you what could happen next in the silver market. And that's where we go next. Because what's driving this is not just volatility. It's positioning, pressure, and something most traders are still underestimating right now. Now let's break the real logic behind this move. Because this is not about news. It's not about headlines. It's about positioning inside a market already under pressure. When smart money sees imbalance, they don't wait. They act early, quietly building positions before the move becomes visible. That's how they stay ahead of the market. Retail investors do the opposite. They wait for confirmation. They wait for headlines. And by the time they react, the move has already started and price is moving faster. That difference creates momentum. Because once price begins moving, new buyers are forced to enter higher, pushing the market further and accelerating the overall move. But there's another layer. Short sellers, traders positioned against the move. When price rises unexpectedly, they are forced to buy back positions, adding fuel to the upside. This is how a silver squeeze forms. Not slowly, not smoothly, but aggressively. Because forced buying combines with real demand, creating a feedback loop that drives price higher rapidly. Now combine this with the current situation. Tight supply from the deficit, rising demand, and early positioning already in place. That creates the perfect setup for imbalance expansion. And when imbalance expands, markets lose stability. Not gradually, but suddenly. That's when volatility spikes, price accelerates, and systems are forced to react to control the movement. That reaction is what you saw in Shanghai. Trading halted, not as the cause, but as the response. A system reacting to pressure that was already building underneath. So this is not a random event. It's part of a process, a sequence where imbalance leads to positioning, positioning leads to movement, and movement leads to forced reactions. And once this process starts, it rarely stops immediately because the underlying conditions remain: tight supply, strong demand, and positions that still need to be resolved, which means what you're seeing right now is not the end. It's the beginning of a larger move developing beneath the surface of the silver market. So the real question is not whether silver moves higher, it's how strong this pressure becomes and how quickly the market is forced to adjust to it. Because when markets adjust under pressure like this, the moves are not small. They are fast, aggressive, and often catch most participants completely unprepared. And that brings us to the most important part. What happens next? Because the next phase is where this situation either accelerates or temporarily pauses before expanding further. Now let's look at the data, because this is where the story becomes clear. Silver has been running in deficit for 6 consecutive years without interruption across global markets. Year after year, supply has failed to keep up with demand, and that gap has been filled by drawing down existing inventories instead of increasing production significantly. That means the system has been absorbing pressure quietly over time, not visible in price immediately, but building underneath as physical silver becomes harder to source. At the same time, demand has not slowed down. Industrial use, investment demand, and silver stacking activity have all continued increasing across multiple sectors globally. So what you get is a sustained imbalance. Not temporary, not seasonal, but structural. A long-term gap between supply and demand that keeps expanding year after year. And historically, when this kind of imbalance reaches a breaking point, markets don't adjust slowly. They reprice quickly, often in aggressive and unexpected upward movements. We've seen this before in previous cycles. Not identical conditions, but similar patterns. Tight supply, rising demand, and sudden price acceleration once pressure becomes visible. And now, for the first time in years, we are starting to see visible reactions. Not just price movement, but trading disruptions like the Shanghai HALT itself. That's important because it shows the pressure is no longer hidden. It's starting to impact real market behavior in ways that cannot be ignored anymore. And when pressure reaches this stage, markets become unstable, not broken, but sensitive, meaning even small shifts can now trigger disproportionately large price movements. So this is not speculation. This is data-driven analysis. The imbalance is real, the pressure is measurable, and now the market is starting to react. Which means the question is no longer if something happens. The question is when the next phase begins and how strong that move could become. Because once markets begin reacting to structural imbalances like this, they rarely stop at small moves. They tend to expand until balance is restored. And right now, based on the data, that adjustment process may have already started. The halt in Shanghai could be one of the first visible signals. So what you're seeing is not isolated, it's connected. Data, imbalance, pressure, and now reaction. And that combination is what usually leads to major market moves. So what happens next? There are only 2 realistic paths from here. Either this pressure continues building, or the market pauses briefly before the next major move begins. In the bullish case, silver continues gaining momentum. And as positioning builds, price accelerates faster. That's when both institutions and retail begin chasing the same move upward. At the same time, Shanghai silver is trading near $92, showing a noticeable premium. Not small, not normal, and that suggests pressure is already affecting pricing across markets. And when premiums start expanding like this, it usually means demand is outpacing supply in specific regions. That imbalance can spread and push global prices higher over time. In the bearish case, the market slows down. Volatility cools, and price consolidates temporarily. But the underlying deficit and pressure do not disappear. They remain in place. So even in a slowdown, this becomes a delay, not a reversal. Because structural imbalances like this rarely resolve quietly once they reach this stage. Now here are the 3 signals to watch: continued volatility spikes, rising physical demand, and more trading disruptions across exchanges. If these appear, pressure is still building. If those signals align, that confirms continuation. And that's when moves become faster, more aggressive, and harder to predict for most participants watching from the outside. I have been wrong before. But historically, when supply deficits and rising demand align like this, the outcome is rarely small or controlled. So the real question is not whether something happens. It's whether you recognize the shift early or wait until the move is already obvious to everyone else. If this halt spreads into next week, especially into Monday trading, then this situation could change very quickly and potentially trigger a much larger move across the silver market. So if you want to stay ahead of this, subscribe now. Because if this develops further, I will break down exactly what to watch next. No hype, just real analysis.